Okay, Bismillahirrahmanirrahim. Let's start with the today's question. Today we are going to start with the final account question, and that final account question is related to Kaplan Mock. And let's see what is the data given over here. And secondly, the most importantly, that what are the requirements and how we are going to solve that particular question. So the trial balance is given over here for the Chestnut at 31st March 2005. First of all, always remember we need to highlight, we need to identify the year end. What is the year end? So we can identify that the year end is 31st March. So at many points we need to remember, we need to recall that the 31st March is the accounting year end. Is the accounting year end. Now there are different account balances that are given over here. That is the share capital, the premium, the property at cost, the plant and equipment at cost, and the accumulated depreciation of plant and equipment, equity dividend paid, preference shares. So there are different line items over there. And one more thing that we can see over here is the draft profit for the year ended 31st March 2005, which means we are not supposed to make the entire P&L or the profit and loss account. We are not supposed to make the entire balance sheet. We are not supposed to calculate the profit and loss, or we are not supposed to prepare the statement of profit and loss. But yes, what we have to do, I think there might be some adjustments, and based on those adjustments, let's see the requirement. Let's see the requirement of it. Here it says that calculate the adjusted profit. Yes, it means the draft profit is already given over here, and what we need to do, we need to just calculate the adjusted profit for the year. It means we need to adjust that particular profit. Now, and the second requirement is quite simple, that is the balance sheet. And in the third requirement, we need to calculate the earning per share. So let's start with the first one. But let's see now what will be the procedure. As I always remember, the procedure would be that first of all we'll try to solve all the adjustment. Once we are done with the adjustments, remember, once we are done with the adjustment, what we have to do, we just need to copy and paste all the relevant information to the drafted income statement or the balance sheet. So that is something that we need to do. Now the information that is given over here, that property had a remaining life of 20 years as at 1st April 2004. Remember, the accounting year ends on 31st March. So it states that the property had a remaining life of 20 years at 1st April 2004. The company's policy is to revalue its property at year end and at 31st March 2005. It means the property was valued, professionally valued at $62 million. Isaac, can you please let me know what is that 62 million?
That's the present value of the property.
Can you please read that adjustment and let me know that what is that 62 million?
That's the previous value of the property.
Previous value of the property. Can you read
it was
the
professionally valued at 62 million, but it gets revalued each year.
Yes. So what is that 62 million? Can you read this statement loudly?
The property had a remaining life of 20 years as at
wait. Slowly. The remaining life of the property is 20 years at the start of the year, right?
Right.
So it means at 1st April, the life of the property was 20 years. Life of the property was 20 years. The company's policy is to revalue its property at each year end, right?
Right.
And at 31st March, so 31st March is the accounting year end?
Yes.
It was professionally valued at $62 million. So what is that $62 million?
The revaluation amount?
Yes, this is the revalued amount. It's a market value. And it's a market value at the start of the year or at the end of the year?
At the end of the year.
At the end of the year. It means the asset was revalued at the end of the year. So first of all, before revaluation, we need to calculate the depreciation for the year, right?
Right.
Okay. Now ignore the deferred tax on revaluation. The best part is there is no need to calculate the deferred tax on that revaluation. Okay. Now the second paragraph. Can you please read the second paragraph, Isa, and read it very slowly and let me know. Please guide me that what it is written over there.
Okay. All plant is to be depreciated at 25% per annum.
Hold on. Can you please explain me that one?
That all the plant is supposed to be depreciated 25% per annum every year, 25% using reducing balance
Nice,
method.
very good. Okay, next.
At 31st March
At
2005.
the start of the year or at the end of the year?
At the end of the year.
Nice.
Chestnut decided to replace all its plant and equipment and put all of it up for sale. Due to the market for such machinery at
Okay,
this date.
Can you please let me know whether all the plant and equipment was sold?
Yeah, they were put up for sale.
Okay, so can you please let me know in which accounting standard that we are now?
For putting them in sale.
Sorry?
For putting them in sale.
Can you identify the standard? If any property is marked for sale, so which accounting standard will be applicable?
Is it IAS 41 investment property?
No. If any property is held for sale, if any of the property is held for sale, so which accounting standard will be applicable? IFRS 5. It's IFRS 5. That is non-current asset held for sale, right?
The discontinued operation?
Yes. That the complete name is discontinued operation. Non-current asset held for sale and discontinued operation. So it means now the plant at the end of the year, it means that we are going to depreciate for the entire year. And at the end of the year, after depreciating it, so plant and equipment was held for sale. And can you remember that at what amount the non-current asset held for sale should be recognized?
Can you give me 1 second?
Yeah, sure.
Oh, yes, sorry.
Okay. Can you please let me know that what is the rule for IFRS 5? The non-current asset should be held for sale. At what amount it should be recorded? Do you remember the rule?
The carrying amount or the fair value less cost to sell?
Carrying amount or fair value less cost to sell, whichever is?
The lower of.
Excellent, very good. So whichever is lower. So it means at the end of the year, we need to calculate the carrying amount of the non-current asset, and the fair value less cost to sell is already given over here, in which it states that the sale of the considered highly probable or profitable in May 2005, the plant was sold for 32 million. It means after the year end or after the reporting date, the plant was sold for 32 million, and that 32 million is considered as fair value less cost to sell, right?
Right.
Okay, now next adjustment, all depreciation is charged to cost of sales. Okay, now second point, the 6% preference shares were issued at par. Isaac, can you please let me know that in which standards now we are? Which standard is being tested over here?
As financial instrument 32.
Very good. Yes, IS 32 or IFRS 9. So it's 6% preference shares were issued. So can you please let me know whether it's a financial asset or the financial liability?
Issued, it's a financial liability.
Nice, very good. It's a financial liability. And we know that the financial liability is calculated by using the amortized cost method, right?
Yes.
Okay, it was issued at par on 1st April 2003. So it means till the accounting period is 31st March 2005. So the financial liability or the preference shares were issued on 1st April 2003. How many years ago?
2 years ago.
Very good. So it means after 2 years, we are doing the accounting treatment, and it was issued at amount $50 million. They are redeemable at a large premium, which gives an effective rate of 10%. So 10% is the effective rate. So 6% is known as what? Yes, if
Uh,
10% is the effective rate, so 6% will be known as what?
the interest
Coupon rate. Six
coupon rate.
percent coupon rate. Now, if we want to calculate, if you want to calculate the interest or the, if you want to calculate, if you want to perform the accounting for the financial liability, are you going to use the fair value through P&L
For financial liability, yeah.
liability? For financial liability, are we going to follow the fair value through P&L?
We do fair value through OCI.
For financial liability, whether we follow the fair value through P&L or OCI or amortized cost.
We do amortized cost over
Yes,
here.
please, Isa, don't forget. Okay, so financial liability, we use the amortized cost. Yes, for financial asset, we might have different options like fair value through P&L, fair value through OCI. But for financial liability, we have only one thing, that is the amortized cost. Are you getting a point?
Yes.
Okay. Now we obviously we have to make an accounting treatment for this one. Now the third one, can you please read the data and let me know that what is written over here, or which standard is relevant for the adjustment number three?
Okay. On 1st April 2004, Chestnut issued a 10 million 4% convertible loan. Repayable for convertible to ordinary shares on 31st March.
So
Mm,
which accounting standard it is? After reading these two lines, can you identify that in which accounting standard we are, or which accounting standard is relevant for that particular adjustment?
it's the same one, the financial instruments.
Yes, it's IFRS 9. And can you please name that particular concept in which we are, which particular concept is relevant for this paragraph?
Oh, wait, what do you mean by concept?
In IFRS 9, there was a financial asset, there was a financial liability, and there was another accounting treatment. There was another accounting treatment.
Split accounting?
Yes, split accounting. This is something related to the convertible bonds, right?
Yeah.
And convertible bond means it's a compound instrument. Am I right?
Yes.
And for compound instrument, we follow which accounting? Which accounting? Split accounting,
Split
right?
accounting. Yeah.
Okay. In split accounting, what we do? In split accounting, what we do? We recognize both the liability as well as the equity, right?
Yes.
Okay. Now, obviously, we need to solve this one, and we need to calculate the interest expense and everything. And one more thing, that this convertible bond was issued on 1st April 2004. When it was issued,
1st April
so it
2004.
means it means only 1 year has passed, right?
Yes.
Okay. Now the fourth adjustment. Fourth adjustment. Can you please let me know from which standard this fourth adjustment has been taken?
So can you scroll your screen? I can't see.
Can you see the data?
No, I can only see the 0.85, 0.74.
Okay.
Okay, now I can see it.
Okay. The
The
adjustment.
directors have estimated the provision for the income tax for the year to 31st March 2005 at 5.7 million. They're
In which
required that
accounting standards? In which accounting standard we are?
IS 12.
Very good. It's IS 12, that is income tax, right?
Yeah.
So it means we need to calculate the tax as well. Now, what we have to do, we just need to calculate the draft, or we just need to calculate the adjusted profit or loss. We'll do, we try to solve all the adjustments one by one, one by one. So let's try the first one. Let's try the first one. In the first one, what we have to do, first of all, there are two assets, as the property and the plant. Let's have an adjustment for the property first. Let's have an adjustment for the property first. Property. Okay. Now for property, what we have to do, we need to calculate the depreciation first, because on 31st March it was revalued. On 31st March it was revalued. So obviously we need to calculate the depreciation for 1 year. Am I right? And then we are
Right.
going to revalue that asset. Okay. Isaac, can you please let me know the cost of the property?
60,000.
60,000. Okay. So the 60,000 is the cost. 60,000 is the cost for property. Okay, 60,000, and the life of the asset. Life of the asset is
20 years.
20 years. So 60,000 divided by 20 years. So the depreciation. So the depreciation. So the depreciation is depreciation of property. Depreciation of property is 3,000. Now, why we have calculated that depreciation? Because at the end of the year, we need to revalue. And as a that, do let me know that in order to revalue the asset, what two things that we need?
We first have to find the difference between the cost and the depreciation to find
Oh,
the
that
revaluation.
is the net book value, right?
Yeah.
Okay, so the cost was 60,000, and we need to deduct the entire depreciation. So the accumulated depreciation of the property, there is no accumulated depreciation for the property. There is no accumulated depreciation for the property, right?
Right.
Okay, so it means we are going to deduct the depreciation that we have calculated right now, that is 3,000. And now we need what? Second thing that we need is
We have the market value 62,000.
market value, that is 62,000. Market value, that is 62,000. Now let's calculate the difference of it, that with what amount the asset is revalued. Is it the upward revaluation or the downward revaluation?
It's upward. It's a gain.
Oh, okay. Number one. Number two, second point. If you are preparing the balance sheet, so at what amount the property should be recorded?
62,000.
Nice, very good. Third question. If we are recording the asset at 62,000, is there a need to calculate the depreciation on that 62,000 for the year?
I don't think so. This was at the year end already.
Excellent, very good. So it is the depreciation for the year is already being calculated, right?
Right.
So it means we are not supposed to calculate the depreciation again. Now the asset will be measured at 62,000. So that adjustment was related to property, and now let's move on to plant. So the plant, for plant, what was the, can you please summarize me that what was given in the information related to plant?
That it's depreciated at 25% using reducing balance method,
Okay.
and they're gonna sell it, and it was
Oh,
sold for 32 million.
okay, it was sold for the 32 million. That was after the reporting date. That was after the reporting date. Are you getting a point?
Yep.
So it means we are not going to sell it out, but yes, at reporting date, we must recognize it as a non-current asset held for sale. We must recognize it as non-current asset held for sale. Are you getting a point?
Yeah.
But obviously, this was done at the end of the year, so we need to calculate the depreciation for what?
For the start of the year.
Okay, for 1 year. Okay. Now let's see the cost of the plant. The plant cost is
60,000.
60,000, and we need to deduct what?
22,000 accumulated
Nice.
depreciation.
Why we are deducting that 66, 60 minus 22? Why we are deducting that 22,000?
Because it's the accumulated depreciation for the year.
It's an accumulated depreciation for the year, and we are doing what? Reducing. We are following the reducing balance method, right?
Right.
We are following the reducing balance method. So it means that cost minus accumulated depreciation, and we need to multiply it by rate of depreciation. Rate of depreciation, right?
Right.
And what is that rate of depreciation?
25%.
It's 25%. So the depreciation of plant is 9,500. Are you getting a point?
Yeah.
Now what we are going to do? We need to compare it. If we are moving on towards a non-current asset held for sale, so it means non-current asset held for sale should be recognized. At what amount it should be recognized?
Lower of carrying amount and fair
Lower
value.
of carrying amount and fair value less.
Cost to sell.
Okay. Okay, fair value less cost to sell. What is the value of fair value less cost to sell?
32 million.
32,000. Okay. Can you please let me know the carrying amount of it? How the carrying amount will be calculated?
48,500.
48,000. How did you calculate this one?
I did 60,000 minus
Okay.
22,000
Nice.
and then subtracted that by 9,500.
Excellent. Very good. So it means 28,500. So it should be measured at lower of. Now, which amount is lower? Either the carrying amount or the fair value less cost to sell?
The carrying amount.
Okay, it means now this property, this plant basically will not be measured at the balance sheet, but the non-current asset held for sale will be recorded, and this will be recorded at 28,500, right?
Right.
Okay, now let's move on towards the next adjustment. Next adjustment, that is adjustment number 2. We are done with the property, we are done with the plant. Okay. Now let's move on to the second adjustment, and second adjustment is related to preference shares.
Yes.
Okay, now preference shares, is it the financial asset or the financial liability?
Financial liability.
Okay, for financial liability, what we do, we make a table for it. And
Yeah.
remember, this was done 2 years ago, right?
Yeah, it was 2003.
Yes, it was 1st April 2003. It means 30th March 2004 and 31st March 2005. So it means we need to calculate the interest for the year 2.
Right.
So 31st March 2004 and 31st March 2005. Now, first of all, the amount at which the amount that was the liability was raised is 50 million,
Yes.
and we are going to multiply what, effective rate or the coupon rate?
The effective rate.
Nice, and the effective rate is
10%.
very good. So it will be 10%. Now, effective rate is 10%, and then we are going to deduct what?
The coupon rate.
Very good. On coupon rate, the rate of coupon is
50,000 times 3%.
very good. 50,000 times
3%.
6%.
Sorry, 6%.
Good. So we are going to deduct it, right? So
Yeah.
for 50,000 plus 5,000 and minus 3,000. Now this is going to be the opening balance for the next year,
Yes.
and we are going to charge 10%, right?
Yeah.
And then we are going to deduct that 3,000. So it's 54,200. So for 31st March 2005, for 31st March 2005, what amount of interest expense should be recorded?
52,000.
5,200.
5,200. Sorry.
Yes, 5,200. Okay. Now this adjustment is done. Now let's move on towards the third adjustment, which is related to convertible bonds. Now, either you will guide me that how this will be done. Convertible bonds. First of all, what we are going to calculate?
We're gonna do 10 million times 4%.
So what we are going to calculate, by the way?
The cash flows.
Very good, excellent. So we are going to calculate the future cash flows for 4 years.
Yeah, 4 years.
Okay, so it means the 10,000 in times 4%, right?
Yeah.
Same will be done for the year 2.
Yes.
What about year 3?
Same.
Okay, for year 4,
We added to 10,000.
nice, very good, excellent, great, mashallah. So 10,000 plus 400. And now what we have to do?
We do it at the rate of 8%.
Okay, so we are going to calculate the present values, right?
Yes.
Okay, so for the year 1, the discount factor that we are going to take?
0.93.
0.93. Then?
0.86.
Then?
0.79 and then 0.74.
0.74, right? So we are going to multiply it. So this will multiply by this, and this is 372, and we are going to total it. So this is 8728. Can you please let me know what is that 8728?
The liability.
Very good. It's an initial liability. Remember, it's a
Initial liability.
yes, it's an initial liability. And if we just deduct the proceeds out of it, the proceeds are 10,000.
Yes.
So the difference amount will be known as what?
Equity.
Excellent. But this is not the end, Isa. This is not the end. Once we have calculated the liability, it's an initial liability. So now we have to make what? What we have to prepare?
The amortized cost table.
Very
Schedule.
good. Amortized cost schedule. Very good. And the table will start from Why we are doing it? Because we need to calculate the interest. So in order to calculate the interest for the year 1, in order to make an adjustment for the year 1, because this convertible bond was issued at the start of the year. So obviously at the end of the year, we are going to calculate the interest. So the table will start from which value?
Financial liability 8,728.
Nice, very good. And what we are going to multiply on that one?
8%.
Excellent. We are going to multiply the 8% out of it. Okay, then we are going to apply the coupon rate 4,000
On 10,000.
on 10,000. Very good. Excellent. So the closing liability would be right.
Yeah.
So we are done with that particular adjustment as well. Now let's move on towards the another adjustment that is related to tax. That is related to tax. Now let's read the adjustment and let's see that what is given over here. Directors have estimated the provision for the income tax year ended 31st March 2000 31st March 2005 at $5.7 million. Can you please let me know what is that?
5.7. That's the estimate.
What is that? Which tax it is?
The current tax.
Very good, excellent. It's the current tax, and the amount of the current tax is 5,700.
Yeah.
Okay. Now, second one, can you please move on? The required deferred tax provision at 31st March 2005 is 7 million. Can you please let me know what is that 7 million?
The deferred tax.
Deferred tax, okay, no doubt it's a deferred tax, but what it is it the deferred tax for the year?
It's the deferred tax. Not for the year. We have to calculate it for the year.
Okay, so what is that 7 million? What is that 7 million?
Um, That's the previous year's deferred tax.
Can you please read the date? At which date this information is given over here?
31st March 2005,
Okay, so what it represents?
the end of the year.
Yes, it's the closing balance. That 7 million is the required deferred tax provision at 31st March 2005 is 7 million. It indicates the closing balance. Are you getting a point?
Yes.
Now, and all adjustment to the deferred tax should be taken to the statement of profit and loss, the balance of the current. It means that is the deferred tax liability closing balance which is given in the question. Now, can you please let me know that this second last statement that the balance on current tax in the trial balance represents the under or over provision of the income tax liability. For which type of information this is given over here?
To find the temporary difference.
Now, this last information, the
Yeah,
balance
to
on the
find the
current.
under over. So
Yes, very good. It's a prior tax, right?
yeah.
Now, let me show you the trial balance, and you just let me know whether it's the under provision or the over provision. Yes, Aiza.
It's positive, so it's under provision expense.
Very good. Expense. So it's 875. Now, we need to calculate the deferred tax over here, and how we are going to calculate the deferred tax. So the deferred tax opening balance was the amount of the deferred tax at the start of the year was
10,500.
okay, great, and the closing balance is
7,000.
okay. So it means if the start was 10,500 and the closing is 7,000. So whether there's an increase or decrease?
There's a decrease.
Very good. Is it an expense or the income?
A decrease is an income.
Very good. So with what amount?
3,500.
Nice. So we are going to deduct 3,500. As am I right?
Yes.
So 3075 is the total income tax. Are you clear with this one?
Yes.
Okay, now let's move on to the last adjustment, that is fifth. On 1st August, Chestnut issued 8 million shares at their full market price of $2. It means the shares are issued. It's simple. There is no bonus. There is no right. There is a simple shares are issued at full market price. So if the company is issuing the shares, so it means company will receive the amount.
Right.
Okay, now how many shares are issued by the company?
8 million.
8 million. And at what value these shares were issued?
$2.
So it means 16,000 is the amount that the bank or the company will receive, right?
Right.
Okay, share capital is always recorded at
Par value.
very good. So this is 8,000 multiplied by
Is it 1, the par value?
very good. And now the remaining amount would be share
Share premium.
premium. So how it will be calculated? 5,000, sorry, 8,000 multiplied by
The difference between 2 and 1.
that is
1.
nice, very good. So are you getting it?
Yeah.
So we are done with all the adjustments. And now what we have to do, we just need to follow the requirements. And let's see the first requirement, that is we need to calculate the adjusted profit. So the adjusted profit that is given away, or the draft profit which is given away here, is the amount of the draft profit is
40,125.
40,125. 40,125. So here we go, the draft profit for the year ended 31st March 2005. Now, first thing, that is the how much profit was there?
40,125.
Okay, 40,125. Now, what we have to do, we need to make an adjustment. First of all, starting from the beginning, first of all, what we need to adjust? Yes, Aiza.
The depreciation.
Very good. Depreciation of
Of the property 3,000.
And depreciation of
Of the plant 9,500.
very good. It's 048 and 055. 048 and 055. 048 048 and 055. So the depreciation expense will be deducted. So we have recorded that depreciation expense, right?
Right.
Okay. Anything else that we need to adjust in that particular draft profit?
Mm-hmm.
Yes. Anything else that we need to adjust in that draft profit?
No, I think from the property, plant, and equipment, that's
Okay.
all.
Okay. Anything else from the other than property, plant, and equipment?
The preference shares,
Okay. And what will be recorded related to preference shares?
the finance cost,
Finance cost. And what amount of finance cost will be recorded?
5,200.
Very good, excellent. So 5,200 will be recorded. 5,200 will be recorded. So let me identify the cell number. It's P66. P66. So finance cost. Finance cost, it's P66. And this finance cost is related to preference shares. Okay. Anything else either that we need to recognize over here? Yes, either.
Um,
We are done with the preference shares. Okay. Anything else?
Tax,
Don't you think that anything related to convertible bond should be also be recorded?
the financial liability, from the amortized cost,
Yes. And what it should be recorded?
the interest amount
Very good.
690.
Yes. 081. 081. We are going to recognize that finance cost again. 081. And this is again the finance cost, but this is related to convertible bonds, right?
Right.
Okay. Now, anything else that should be recorded?
And the deferred tax,
Total income tax, not only the deferred tax, but the total income tax, that is 088, right?
right.
So it's 088. So that is the income tax. This will be deducted. So any other adjustment? We have another adjustment that is related to the full market price shares, but this will not impact the P&L or the income statement, right?
Right.
Okay, now let's calculate the adjusted profit. Let's calculate the adjusted profit. The adjusted profit that we have calculated is 18651. Adjusted net profit. Are you clear with this one now?
Yes.
Okay, now second requirement is that we need to prepare the balance sheet. We need to prepare the balance sheet. So let's prepare the
Yes.
statement of financial position. Statement of financial position. Statement of financial position. Now, how it will be calculated? How it will be calculated? First of all, we need assets, and
Yeah.
let's see. Let's see first of all in the trial balance that what assets do we have? What assets do we have? Yes.
The inventory.
Sorry.
The inventory.
First, if we need to identify the non-current assets, so which non-current asset do we have?
Property.
Very good. And now you will let me know that at what amount the property should be recorded.
At the revalued amount.
Very good, excellent. And what is that revalued amount?
I think it was 62 million.
Yes, you think very right. So it's 62 million. That is 051, 051, 051. Property. That is 051. Okay, now plant. Are we going to recognize the plant?
Uh,
Are we going to recognize the plant?
wait, can we go back to the planned calculation?
Yeah, sure.
We record the carrying amount.
We will not recognize the plant, but we will recognize the non-current asset held for sale.
Yeah.
This will not be treated as non-current liability. Instead, it will be treated as current liability. Are you getting a point?
Yes.
So it's 059. We are going to recognize it 059, but this will be recognized under the head of current assets, non-current assets held for sale. 059. Are you getting a point?
Yeah.
Okay, what other assets do we have? If you just start from the beginning, property we are done, plant is no more, equity dividend preference shares the liability, convertible loan note is the liability. Okay, inventory. Inventory, the amount of inventory is going to be
35,250.
35,250. So 35,250 will be recognized in the inventory. 35,250. Okay, anything else?
And the trade receivables,
Okay,
41,375.
trade receivables 41,000. Trade receivables 31,000.
No, 41,375.
41,375. 41,375. Okay, great. Now, afterwards, after trade receivables, what asset do we have?
Bank, 34,350.
Okay, bank 34,000. Bank is 34,000. 34,350. But there is something else that we need to account for. That since we have issued this number of shares, right?
Right.
And you can see that the bank is debited by 16,000. It means we will receive the amount of 16,000. Are you getting a point?
Yeah.
So it means that 16,000 will increase the amount of bank. The 16,000 will increase the amount of
Bank.
bank. So it means the bank will be added up. 34,350 plus 16,000, the bank will be added. Any other asset that we have? Trade payables and then preference shares retained? No, none of that. There is no other asset. There is no other asset. Am I right?
Yeah.
Okay, now let's calculate the total of it. It's 217,475. 217,475, right?
Right.
So that is the total assets. Now let's move on towards the liabilities side, liabilities and equities. So first of all, let's equity and liabilities. First of all, we will have share capital.
Yes.
Now either you will let me know that what amount of share capital that we should record.
Share capital. Wait, can you go down to the notes?
Nice. Okay.
I think we did calculate share capital.
Share capital is already given in the trial balance.
The 42,000.
Is there any adjustment related to share capital?
Yeah, I think we did do an adjustment.
Okay. Do you remember the adjustment? Which adjustment that we have done?
8,000.
Yes, we have issued the shares at full market price, right?
Right.
So it means that we are going to add this 8,000. So 091, 091. So it was 091 plus. Already we have $42,000
Yeah.
share capital. So it's 50,000 share capital. And then we have another equity component, that is the share premium. The amount of share premium that is given over here is
8,000.
there any adjustment required?
Yeah, we calculated 8,000.
Yes, we have calculated the 8,000 as a share premium. So we are going to link that one, that is 8,000 plus 8,000. Now, we have also calculated the equity component related to convertible bond. Remember?
Yes.
So this will also be recorded. And the amount of that equity component is
1,272.
very good. Now, anything else? Let's see on the trial balance. Share capital we are done, premium we are done, property assets, plant asset, equity dividend paid. This will be deducted from the retained earning. Remember, whenever the company has paid the dividend, so this will be deducted from retained earning. Are you getting a point?
Yeah.
Okay, 6% preference shares. Is this going to be recorded in liabilities?
No, we do the new one we calculated.
Excellent, very good. So we are going to 6% preference shares. So it's 6% preference shares. So do let me know that what amount that we need to record.
Um, 54,200.
Very good. It's R66. It's R66. Okay, great. Anything else? 6% preference shares that we have written. Anything else? Whether there will be a convertible loan note?
No, we did the convertible.
Okay, so which value that we are going to put in? From the trial balance?
Did we do the proceeds we found?
Yes. Are we going to take convertible loan note, the liability that we need to recognize? Liability that we need to recognize in respect of the convertible loan note. Yes. At the end of 31st March.
Yeah, we take the liability then.
What will be the amount?
We use the proceeds, right? 10,000.
10,000 is the total proceeds that we have received, but this will not be recognized as a liability.
Okay, then it's 8,728.
8,728 was the initial liability. We are today at the end of the year.
Wait, then we take it from the amortized cost schedule.
And that amount is
9,026.
Very good. Are you getting the point? I said,
Yeah.
do remember that we are recognizing the liabilities at the year end. So that 8,728 is the liability at the start of the year, but we need the liability at the end of the year. For that, we have made it or prepared an amortized cost schedule, and this is 9026. Are you getting a point?
Yeah.
It's Q81. It's Q81. Are you getting a point?
Yeah.
Okay, now after convertible loan notes, any other liability that we have? Inventory, trade receivables, bank, any other liability that you can see?
Deferred tax.
Okay, very good. But before that, we have trade payables as well, right?
Right.
So trade payable is amounting to 42,000. Trade payable amounting to 42,000. Trade payables amounting to 42,000. Okay, anything else? After trade payables, do we have any other liability?
We have retained earnings.
Okay, we forgot that retained earning, right? Yes, we forgot that retained earning. It should be over here. Very good. Retained earnings, okay. Retained earnings. The opening retained earnings that were given in the question is
12,125.
12,125. So it's 12,125. 12,125. Okay. Now, what adjustment that we need to make in that one?
We subtract the dividend paid.
Okay, the dividend that we have paid is
12,500.
great, 12,000. Any other adjustment that we need to make in? Yes, any other adjustment in the retained earning that we need to perform?
Can you go to the calculations? And we add the adjusted profit.
Yes, we added the adjusted profit, which is D100. Are you getting a point?
Yeah.
So this is the retained earning. Any other equity, any other equity component that will be recorded over here?
Okay, the revaluation surplus.
Yes, revaluation surplus. So what was the amount of revaluation surplus that we have calculated?
5,000.
Yes, it's 5,000. It's 052. 052. Okay. Anything else?
Do
Now
we
in
take the
liability,
revaluation from the trial balance as well?
there is no revaluation surplus on the trial balance, I guess. Yes, it's
Yeah,
there.
there is
Yes,
9,000.
yes. Very good, very good. We are going to add it. So this is 9,000 plus. Yes, absolutely right. So it's 9,000 plus 5,000. Very good. Okay. Now, is there any other liability that we need to account for over here?
The deferred tax.
Very good. We are going to add the deferred tax liability. So what is the amount of deferred tax liability at the end of the year? What is the deferred tax liability at the end of the year?
7 million.
7 million. Yes. It's a deferred tax closing balance. That is 7 million. That is 7,000. Are you getting the point?
Yeah.
There will be another liability that is known as what? Income tax payable. Always remember, in case of a liability, two liabilities will be recorded. Number one, the income tax payable, and the second one is the deferred tax liability. So the income tax payable is basically the current tax for the year. Income tax payable means the current tax for the year. So the current tax for the year is
5,700.
yes 5,700. So this will be recorded as 5,700. Are you getting a point?
Yeah.
Yes. Any other liability or adjustment that we need to make?
I think that's all.
That's all. Okay. Let's try to total it. 217,475. Yes, 217,475. That is the equity and liabilities. So the balance sheet, both sides are equal. Both sides are equal. Are you getting a point?
Yeah.
Now, these were the two requirements that we have seen. That is the draft adjusted profit that we need to calculate. The balance sheet that we have prepared is for 12 marks. Now, 3 marks, there is a requirement for the basic earning per share that we need to calculate. So, in order to calculate the basic EPS, what is the formula? Yes, what is the formula?
We find the inverse of the bonus fraction.
For basic EPS, first of all, calculate or what will be the formula to calculate the basic EPS? Yes, what is the formula to calculate the basic EPS?
Wait, the shares after over shares before.
EPS, basic EPS formula is profit after tax divided by weighted average number of shares, right?
Wait, isn't that for the diluted?
No, it's not for the diluted. It's for the basic EPS. For diluted, what we do that
Oh, we
we
add interest.
yes, we add interest, we deduct income tax. Are you getting a point?
Yeah.
So this is a simple formula that is profit after tax that divided by weighted average. And profit after tax that we have already calculated. Profit after tax that we have already calculated is 18651, right?
Yeah.
Now this is the profit after tax. Now we need the average number of shares. Average number of shares. Isa, now you just let me know that is there a need to calculate the bonus fraction or not?
No, they didn't issue any bonus fraction.
Excellent. There is no bonus or there is even no right shares, right? Yes,
Yeah.
there are few shares they have issued, but that is at the full market price. So obviously we are going to calculate the average number of shares, but there is no need to calculate the bonus or the right fraction, right?
Yes.
So at the start of the year, that is at 1st April, the ordinary number of shares that we have already in the market is 42,000.
Yes.
It's 42,000. It's 42,000. And then we are going to multiply it. Then when we have issued the shares at full market price on 1st August, right? We have issued
Yes, 1st August 8,000.
okay. So it means that April, May, June, July, August. April, May, June, July, and August. After how many months? How many months?
5 months.
5 months. So multiply by 5 and divide it by 12. Multiply by 5 and divided by 12. Am I right?
Yeah.
Okay. Now, after the full market, after the shares were issued at full market price, and it was done at 1st August. So now, on 1st August, on 1st August, how many shares were issued? How many shares were issued?
8,000.
8,000. Now the total number of shares would be
50,000.
yes, and this will remain for how many months?
For 7 months.
Very good. Multiply by 7 and divide it by
12.
12, right? Multiply by 7 and divided by 12. Are you getting it?
Yeah.
So now the weighted average number of shares would be 64.66.7. Are you getting it?
Yeah. Don't we multiply 42,000 by 5 over 12 and then 1 and then the second one by 2? Like to find the TERP?
No need to calculate the TRP. Why? Because there is no right shares. Always remember, Isaac, we do calculate the bonus fraction, the right fraction, and the TERP once the company has issued shares, and once the company has issued right shares or the bonus shares. There is no
Okay.
right shares. The shares were issued at the full market price, so there is no bonus element. For example, if the market price is $2.2 and I have issued the shares at the same price, so there is no bonus element. So there is no need to calculate the bonus or the TERP. Are you getting a point?
Yes.
So this is the weighted average number of shares we have. And now we are going to divide it and we are going to calculate the basic EPS. That is profit after tax divided by this. So $0.29 is the basic EPS. Yes. Are you clear with this one?
Yes.
So there is no need to calculate the right fraction, bonus fraction. Why?
Because it's not written within the question.
Okay, so it means the shares are issued at full market price, so there is no bonus element. Am I right?
Yes.
Any confusion in that one?
No, sir, I understand.
Now you have to attempt that question. You have to reconsider that question once more, okay?
Okay.
And then do let me know if there is any problem. Now I'll be sending you the quiz 3, that is the grand test 3,
Okay.
and try to attempt it as soon as possible. But before that, you need to attempt one specimen or the practice exam 1 or 2 from the practice platform. Are you getting a point?
Yes.
And do let me know the results of it. And if there is any problem or confusion, do let me know. There are a few questions that you have sent to me that is related to MCQs or the section A or B. We will solve it in the next class. Okay?
Okay.
Any confusion either so far?
No, sir, I understand.
And what is the main? What is the next target for you?
I'll solve the practice platform, the bundle,
Great,
and then I'll do the ground test that you sent.
great.